Let's be honest, becoming the beneficiary of a life insurance policy can be a really complicated moment. On top of everything else, you're suddenly starting a financial journey with some pretty critical decisions ahead of you. So today, we're going to walk through that journey step by step to really understand all of your options. All right, so let's dive right in with the big question. The news has been delivered, you've submitted the necessary paperwork, like the proof of death. So, what actually happens next? How does this whole process really work, and what choices do you have? Okay, so the first thing you gotta know is that there's a standard, automatic way this all kicks off. Once the insurance company gets that death certificate, the wheels are set in motion. And it all starts with the most common payout method there is. And that default option? It's called the lump sum. And yeah, it's pretty much exactly what it sounds like. The entire death benefit gets paid to you in one single check. It's clean, it's simple, and if nobody specified anything else, this is what happens. But, and this is a big one, here's a crucial rule you absolutely need to know. The person who owned the policy can pick a settlement option ahead of time. And if they've already made that choice, it's locked in. As the beneficiary, you can't change it, which really shows you just how important their planning was. So, let's assume the policy owner didn't lock in an option. Now the ball's in your court. You, the beneficiary, have choices. And your first decision isn't even about the long term. It's about whether you take all the cash right away or give yourself some breathing room to think. And that brings us to your first big decision. On one side, you've got the lump sum. You get all the money right now, and it's on you to manage it. On the other side, you have the interest-only option. This is where the insurance company holds onto the principal for you. You just get the interest it earns, which gives you a little income and, maybe more importantly, time. So, how does this interest-only thing actually work? Well, you can think of it like a super secure holding account. The insurance company keeps the principal safe and sound, and they pay you a guaranteed minimum interest rate. Now, one thing to remember, those interest payments, they're taxable. But the real beauty of it is the flexibility. You usually have the right to pull out the full amount whenever you feel ready to make that bigger, long-term decision. All right, so once you've had that breathing room and you're ready to think more long-term, we move past that first choice. The next set of options is all about one thing: turning that single death benefit into a steady, predictable stream of income. Kind of like creating your own personal pension. Now, when you get into these annuity-style options, they really boil down to two main flavors. You can either focus on the amount of money you get each month, or you can focus on the period of time you get it for. So the question to ask yourself is, do I need a specific income, or do I need that income to last for a specific number of years? First up, the fixed amount option. With this one, you're totally in the driver's seat when it comes to the payment size. You might say, look, I need exactly $1,200 a month to cover my bills. The insurance company will then send you that amount on the dot every single month until both the principal and all the interest it's earned are gone. The priority here is hitting that number. Now, the fixed period option, it just flips that whole priority on its head. Here, the timeline is everything. You might say I need an income for the next 10 years, until my kids are through college. The insurance company then does the math and calculates a payment amount that will last for precisely that 10-year period.
Okay, now we're getting into what you might call the ultimate peace of mind option. What if you don't want to worry about the money ever running out? Well, these next options are built to be a financial safety net that lasts for the rest of your life. No guesswork.
So, here's the core promise of the life income option. The insurance company takes that death benefit and, poof, turns it into a personal pension that you literally cannot outlive. Payments are guaranteed for as long as you live. But it's not quite that simple. Inside this powerful category, there are a few really important variations you need to know about. First, you've got what's called straight life. This one's going to give you the biggest possible monthly check from the pot. But here's the catch, and it's a really big catch. The second the beneficiary passes away, the payments stop. Completely done. It's a high-risk, high-reward option, often for someone with no dependents who just wants to maximize their own income. Yeah, if that sounds a little too all or nothing for you, there's the refund life option. This one is all about safety. It comes with a guarantee that the entire original death benefit will be paid out one way or another. If you pass away before you've received that full amount, the rest of the money just goes to your survivors. Then you have this cool hybrid option, life income with a period certain. It's kind of like the best of both worlds. It gives you income for your entire life, but it also guarantees payments for a minimum amount of time, say a 20-year period certain. If you pass away after just 15 years, your secondary beneficiary will still get paid for those remaining 5 years. And last but not least in this category, we have the joint and survivor option. This one is designed for a very specific purpose, to provide an income stream that covers 2 lives. As you can imagine, this makes it a really popular choice for married couples who want to make sure the surviving partner is taken care of for life. All right, so we spent a lot of time on the how the money gets paid out. Let's switch gears and talk about the who. I mean, who can even be a beneficiary in the first place, and what are the rules around how they get named? And when it comes to who can be a beneficiary, the system is, well, incredibly flexible. You can name a specific person, like a spouse or a daughter. You can name a whole group, like all my children. It can be a business, a charity, or even a trust to manage the money. You can also name your estate, but that's usually not a great idea because it can open up a can of worms with legal stuff and taxes. Okay, this is one of the most important distinctions to get right: revocable versus irrevocable. With revocable, and this is by far the most common, the policy owner can change it whenever they want. No permission needed. But irrevocable? Whoa, that's a whole different ballgame. An irrevocable beneficiary has a legal right to that money, and you can't take their name off without their written permission. It even limits the policy owner from taking loans on the policy. So what happens if you're the policy owner and, life happens? You get married, have kids, get divorced, your situation changes. How do you actually go about updating your beneficiary? Well, the good news is, it's actually pretty straightforward. Basically, there are 2 ways to do it, but honestly, one is way more common these days. It's called the filing method. All you have to do is send a written request to the insurance company. That's it. The change takes effect on the date of your request. The other, older way is the endorsement method, where you have to mail in the physical policy, but you don't see that very often anymore. This quote really gets to the heart of it all. It boils down to a balance of power. The default setting is freedom and flexibility for the beneficiary. But with a little bit of planning, like choosing a settlement option or naming any revocable beneficiary, the policy owner can put specific rules in place to make sure their wishes are followed to the letter. At the end of the day, all of these options, all these rules, they're just tools. They're tools to help someone protect the people they love most. The technical details matter, sure, but they all serve a much bigger, much more human purpose. So the final question isn't just about the money. It's your legacy is more than money. How will you plan for it?